And when we think about the future of travel, there's a pretty clear indication with everything that's happened here, where we're seeing that technology is the key to the future of hospitality. It's no longer a nice to have. It's no longer a trade-off between technology and hospitality and human service. All of these things come together and enable each other. And so we looked at this and we wanted to bring in the best investors, the ones who have seen multiple market cycles, who have worked with dozens of portfolio companies. And so we kind of scoured our network for these really remarkable individuals and wanted to bring them to you for what is basically going to turn into a virtual board meeting where you guys can ask them questions live on YouTube. And we can also just get a really great discussion going about what they're seeing with their portfolio companies. So without further ado, I'm going to introduce some of our panelists. So first up, we have Matt Melimuka. Matt is a co-founder and partner at PeakSpan Capital. PeakSpan is a software-focused VC that recently raised a $265 million fund. Matt has been involved in multiple software companies in the hospitality and travel space, and is just one of those investors who really rolls up his sleeves and gets in there from an operational perspective, making connections and really helping his portfolio companies and founders get to the next level. And an investor like Matt is really invaluable in a time like this. So welcome, Matt.
Jordan, you're far too kind. We've got a lot to live up to on this panel, but sincerely appreciate the kind words. Really privileged to be here and to talk about what we're seeing and what some of our companies are doing to really weather the storm here. So pleasure to be here. Thanks.
Absolutely. Matt, can you share with our audience a couple of your investments in the space and just super quick and how you're looking at hospitality you're invested?
For sure. I'll give a quick thumbnail on PeakSpan and then talk about a few investments. So at PeakSpan, as Jordan noted, so we're a growth stage investment partner. So typically partnering with companies that are kind of past the point where you've got, a PowerPoint and a dream, and you've kind of answered some of the existential questions around, can we build it and will they buy it on terms that are profitable for us as a business? And you're looking for capital and a partner to help you scale to the next level. A lot of the challenges and opportunities that our companies face are related to operational execution, sensible scaling initiatives versus getting product market fit figured out. They've typically got that figured out when we come in and partner. We take a very focused model. So we only invest in business software. That used to be a kind of a narrow aperture, and now business software is massive. And so by virtue of that, we further kind of refine our lens and focus on a couple discrete subsegments within business software. And so I'm one of the co-founders and partners here, and I lead our hospitality tech practice. And so I spend a significant portion of my time living and breathing in these categories that the companies that I partner with do to try to get a really nuanced understanding of buyer dynamics, macro trends, and competitive environment and all that good stuff. We've been really active. I'm on the board of a company called Cloudbeds, which is in the cloud-based PMS arena, providing property management systems for the long tail, independent hoteliers, bed and breakfast, hostels. We invested in a business called Zingle, which was acquired by Medallia last year. That business essentially did smart texting for hoteliers. Really interesting company and kind of innovative solution, enabling hoteliers to kind of take control of the guest experience back. And then most recently, we partnered with, and I'm on the board of a company called Oki, which is in the automated upselling arena. Essentially what Oki does is deliver a really, really interesting solution, leveraging elements to personalize bundles with regards to ancillary services and goods that a hotel can offer to the right guest at the right time to try to get them to purchase those goods and services before they come to the property. Again, just delivering a great experience, taking economic back and some of the power back from the OTAs, the online travel agencies, which is just all goodness. And so those are a few, and happy to talk about what they're doing.
Cool. Lucky to have you. Thanks so much for coming, Matt. So next, Matt talked about PeakSpan's focus on software. Speaking of focus, so Chris Hemmeter is the co-founder and managing director at Thayer Ventures. So Thayer just raised an $80 million fund to focus exclusively on travel and hospitality. Chris is a legend in this space. You name a company and he's probably invested in it in travel and hospitality. So Chris, we're lucky to have you, and thanks so much for taking the time today.
My pleasure. Yeah, thanks for having me. Just following on Matt's description. So we are at Thayer Ventures, as you know, we're Series A, Series B investors. So typically we're the guys making investments in companies where they still are trying to figure out the product market fit. They've typically moved beyond that seed stage, invention practice, but are beginning to operationalize a product market fit. And then we hope to, gussy them up and take them to Matt and look for follow-on support. So yeah, Thayer, we're investing out of our third fund, as you mentioned. Our firm has been built from the very beginning with an exclusive focus on travel and transportation. We invest globally, hospitality, and all things related to accommodations is a major focus area for us.
Yep.
So we have investments ranging from Sonder, which is a really interesting sort of revolutionary player in this concept of distributed hotel platforms and this merging world of private accommodations and hotels.
Yep.
We've invested in a company called Muse Systems, which is very similar to Cloudbeds, but focuses on a slightly different part of the marketplace. It has an integrated payments component operating in 54 countries now. We have another really interesting investment in a company called Opti, which is using technology to basically manage housekeeping differently. And that has gone from a quiet little company to sitting in the cool spot suddenly, given
Yep.
everyone's obsession with cleanliness and the incredible overhead cost of housekeeping.
Yep.
And then other companies like Beekeeper, which is a enterprise grade messaging platform and connecting frontline workers to corporate digital infrastructure, and then many others. Anyway, all of our portfolio is in travel and transportation, so I could carry on for a while with all those names.
Awesome. Well, thanks for coming, Chris, and we're looking forward to learning from your experience here.
Thank you.
Yeah.
Glad to be here.
So next up, we've got Dave Burkus. So Dave was the creator of Fosse, so the PMS system that Marriott used for, Dave, how many years?
38 years.
38, I was close. Dave was also named by Inc. magazine as a super angel and seen over 200 startups personally. Dave has seen it all. He's been on the operator side. He's been in the investor seat, and he really needs no introduction. Dave, thanks so much for coming. Want to tell us a little bit about what you're invested in today? What's getting you excited?
What's really interesting is I usually go pre-seed and seed. And so I fit well underneath where Chris is. So I throw things at Chris throws things at Matt, and we have an ecosystem right here on the screen.
Well,
I have invested.
If you take greater fool theory, then you're in the right part of the value chain.
I've invested in 202 companies. I manage 7 funds. They are all live at this time. They're small. Remember, these are seed and pre-seed. So they sum to around 22 million, but each one of them is pretty small.
Yeah.
And the latest fund, Wayfair Ventures, is the one we'll talk about when we get down to it. But Wayfair makes investments only in travel tech. So we follow very closely what you heard from both Matt and Chris.
Yeah.
And it's interesting that we were heavy into Cloudbeds, Matt. And so when I heard that Chris was heavy into the competition, it became kind of fun. Cloudbeds had a recent liquidity event. It was small. We did not participate because we discovered that it was only offering the first $10 million worth of shares. And we had enough shares that we were being cut back to 30% or less. So we've kept our shares happily. And we think it was a good investment. So, Matt, we rely on you for that.
There's a lot of value to be created from here, Dave. That was a smart idea, smart play.
Thank you. Well, I'll tell my partners that because that certainly makes me look better. In Wayfair, at this point, a very young fund. We've only made 7 investments, but they're interesting ones. Yeah. And so just to mention a few very quickly, because they have been affected in various ways by what's happened to us in COVID. For instance, I'll pick the one that has been affected the worst. It is called Park, P-A-R-Q. And it was all about parking cars at major events because the major events always filled the parking lots. The neighbors had, they had their driveways.
Yeah.
And a neighbor could put in as much as 10 cars in their backyard and their driveways. And I couldn't believe that they were charging $150 per car and they were getting it. So at the time, we invested a little bit in it because it was a very small company at the time. And then, of course, COVID hit. Nobody had any events.
Yep.
And these guys pivoted beautifully to licensing software to garage owners who fill their garages, speaking now of business clients, and need to have excess capacity from other garages. And this automates that entire process. It's an interesting pivot for a company in our industry.
Yep.
And then we go for the ones that have pivoted 3 or 4 times. We have co-invested. He was 1 round ahead of us, but we all kept up with him on Group Eyes. And Group Eyes has pivoted 3 times. I think they're in the right place right now if they had customers, and that's something that they're beginning to get again. So we have something together on that one to try and to coach. And
Indeed.
yeah, I've been coaching Charles. You've been coaching Charles. I don't know whose information he takes first, but we'll find out. And then there are some really interesting ones. For instance, the health of maids is important. And so there were 3 or 4 companies that came to market this year, 2019, that help protect maids that turned out to have anything from panic buttons to other forms.
Yep.
And we invested in one of them that we thought was very good. And that one is one that will recover fast if the industry does. And so we're looking for that one. And then there are 5 more that I'll talk about maybe, but 202. And so you can ask me later on how I managed 202 investments.
We'll definitely dive into that. Awesome. Well, Dave, thanks for that. And speaking of Dave, we've got another Dave here. We've got Dave Vaughn from TCB. Dave has invested in 4 companies that have gone public, 8 that have been acquired, and has been recognized by Forbes on the Midas list of top 100 technology investors. Dave is heavily active in the travel and hospitality space and is a real thought leader on kind of SaaS software, software as a service and marketplaces and the unit economics of those marketplaces and how software companies evolve over time. Dave has invested in some really interesting companies in this space that have really exploded and sits a little further down in terms of the stage of investing. So Dave, thanks so much for joining us today.
Yeah, maybe I'm a good bookend to the other Dave. We're a growth equity, private equity player, and so perhaps we are the greatest fool on this video conference. I hope not. But we manage close to 13 billion capital, make investments of 100 to 300. So big concentrated bets, minority, majority, at times public, and we aspire to be global. I'm not sure we're quite there yet, but we are very active in terms of US, EU, Australia, New Zealand, and opportunistically Asia.
Yeah.
The particular investments in the space, direct investments would be SiteMinder in the hotel space, and then Toast in restaurant. We've done a bunch in online travel, Airbnb, Expedia, HomeAway, Klook, and you may not think of Rover as a travel company, but in fact, they do service essentially the travel use case. And then, as Jordan mentioned, we are very prolific in SaaS and particularly SMB SaaS. So companies like LegalZoom, CCC, Avetta, and a number of other players.
Absolutely. Thanks so much for joining us, Dave. So let's hop in here. So Dave Burgess, I want to get started with you. So when we were chatting last week, you had told me that basically, I think it was within the first 2 weeks of this crisis breaking out, we're now 3 months in here. You had in 1 week, you had about 20 calls with CEOs. So my question to you guys is, as investors, like, how has your day-to-day changed in terms of how you're engaging? Like, what's the, we have over 100 live listening now. We'll have thousands that listen later on of technology executives and founders. What should they be expecting from their investors? And have you guys really changed what you do and kind of evolved your role as an investor in these companies to guide them through this crisis? Dave, you want to start us out?
Sure. I mean, there are 2 questions you asked. The first is, what did I do for those 20 companies? And the second is, what do we do ongoing? And I'd like to bring Chris in when that comes as well.
Mm-hmm.
But first of all, I began making telephone calls as soon as I knew we were all sequestered, as soon as I saw the occupancy of the hotels go down to 20%. And so I had 3 questions. for these suppliers. And the first was, what's your runway? Help. These are young companies that are fragile, and first and great question. And they all answered that one, I think, accurately. And they all had PPP applications at the time, and most of them got them, and that helped in the runway. Cloudbeds had just finished, help me, Matt, an $87 million valuation, $38 million that they took in, and they have 3 years worth of runway.
That's right. They actually took in about 80 plus, and we'll keep the valuation confidential, but it was significantly higher than that.
Nice. Thank you. Well, I've got to value everything in the portfolio, so please whisper in my ear sometime.
I'll talk to you offline about it for sure. But yeah, 80 million on the balance sheet.
Good. Well, anyway, it's the surprise, because that one happened during COVID. Of course, it started first. I expected that one to be a problem when COVID hit, and it didn't. So I asked those 3 questions. The first was, what's your runway? And when I heard Adam tell me that number, I think I fell on the floor and took a moment to get my wits back. The second question is, now that you're locked up and your employees are pretty much locked up too, what are your plans for what happens the day that you're released? What are you going to do that makes you different from everybody else? And I was asking the question for marketing reasons, because it's an old adage that companies that make a splash early on after one of these events or something like this are visible. They become the leader in a marketing sense because they're so very visible because they spent so much.
Yeah.
Most of the companies are afraid to spend. So what's your plan? And the third question is, how are you going to execute it once you're out there? In other words, anybody can have a plan. And I got similar answers, and they weren't necessarily good. This was early on.
Yep.
None of them had a plan. None of them had marketing whatsoever. And so I coached the first, 5, 6, 7, or 8, but it became so consistent that I stopped making the calls. It wasn't doing any good. They weren't thinking strategically. They were thinking tactically. And you can come back to me later on and I'll tell you how you ask questions that get them to think strategically. But that's what happened.
Yeah, absolutely. Actually, that brings us nicely to Dave One. I saw some really interesting stuff that we'll get into later with Toast's gift card program and SiteMinder's Global Hotel Index. How is your cadence and your kind of communication with your portfolio companies changed during this time, and how are you kind of evolving that as we start moving into this next phase?
Yeah, I would say that right now is actually quite different than let's say March, and I give a lot of credit to the management teams of our companies. I think when this thing hit, the benefit of being global is actually from a TCV portfolio perspective. We saw it happen in Asia, we saw it happen in the EU, and so we were able to help our companies take this threat seriously. But if you think about it, there have been a bunch of health threats that haven't really flown through the P&L. And so this mindset shift from growing 100% year over year and winning the market and path to glory to really understanding that GMV may go down 80, 90% in your customers, and therefore there may be some bankruptcies that flow through your business. It's just a really hard thing to grok. So in March, the big steps I think our companies took, and again, I give our management teams a lot of credit, and I think and I'm proud of the role that TCV played in this, was first take the threat very, very seriously, which usually means you have to take some very hard measures. And these are very emotional measures, but absolutely the right ones, which is usually cut hard so you can start looking forward rather than looking back. You want your executives, employees to know their jobs will be secure going forward, which means you have a strong financial balance sheet. So that's point number one. Point number two is it's typically very hard to change out the engine when you're driving 100 miles down the highway. This is sort of the metaphor of a fast growth company. There's a bunch of things that you need to address, but you just can't because your companies are growing so quick. Recognize that your car's in the shop, and the good news is every car's in the shop. All your competitors are in the shop. So take this time to actually work on some of the long pole tent pieces. And if you do those first two things, then you get to go and play offense sooner than other folks. I think Dave mentioned this in a marketing context. I think this is true across the board, whether it's hiring, whether it's M&A, so on and so forth. So The really cool thing I saw with Toast, I think you're addressing this directly, Jordan, is Toast really pushed hard in two capacities, two product areas. One was to really ramp up self-service and make it so that their customers could onboard on their own and remotely. The second is to launch a product called Toast Now. And Toast Now essentially was a way for restaurants to engage with the different demand channels, and probably more importantly, to take online orders and curbside pickup. In the course of 5 weeks, they generated billions of GMV through that product, which was great for our P&L, but more importantly, we helped our restaurants and our entrepreneurs actually receive billions of revenue that essentially are the lifeblood of these restaurants. So it's a really cool effort to see the company mobilize and to react so quickly.
Yeah, I think it brings up two really interesting points of like these kind of dichotomies that we're seeing, or these misconceptions. Is like, one, when cuts were happening, there was just a lot of bad PR around those cuts. But I think what people don't realize is that you're cutting 40-50% of the team so that you can save the other 50%. And it's not, it's like the running for the high school election to be president. Everyone gets free lunches and A's. Like, it's just being pragmatic and really taking that leadership and being able to do that is super critical. And then I think the other one is like this idea that capitalism is about kind of a zero-sum kind of greedy game. But what you're pointing out with Toast is that the way that you guys boosted the P&L and getting that GMV up is basically figuring out how to add the most value for your clients, which is really awesome. And so I think that leads us nicely into the next one that we could have Matt and Chris lead us off with is, what are some of the interesting kind of pivots from your portfolio companies or really creative strategies that, Dave Bergen stealing share and getting your share of voice out there? What are some of the things you guys have seen with your portfolio companies? Whichever you guys would like to take it away, happy to.
Go ahead, Matt.
Yeah, sure. So appreciate it, Jordan, and I'm glad you referenced, the zero-sum game kind of concept and misconception with regards to capitalism. I think a lot about, in particular in this environment, not to get too academic, but Adam Smith and his principle that he talks about in The Wealth of Nations called rational self-interest. So essentially this principle that, people pursue rational self-interest and it's good for everyone. And so his kind of analogy is the butcher prepares you your dinner, not because he's benevolent, but because he wants to get paid. And there's this kind of virtuous cycle of commercial virtue that comes out of it. And so I think about that in the context of what our companies are doing and how they reacted to this environment, whereby you can do goodwill and it can be good for the customer and it can be good for the company. And so it's kind of this mutually beneficial thing of everyone pursuing their own rational self-interest, which includes goodwill, economic concessions and the like. I'll talk about Oki, for example. Oki is the upsell automation platform that I referenced. With nobody going to hotels, nobody is upselling ancillary services at the property, right? And so their current customer base, they work with over 1,500 hotels. They're not getting foot traffic, and so they don't necessarily have cash to pay, or if they do, it's going to be onerous for them to pay a normal kind of rack rate subscription fee. And conversely, new prospective customers could surely use a solution like this. Dave, to your analogy of fixing the car, every car's in the shop, but a lot of those car owners need a new bumper, but they can't pay for it yet, right? And so they really want it, but they can't get the solution. So Oki did a couple of really interesting things, which I think, enabled goodwill, offered kind of short-term economic concessions to the customer, and they were longer-term beneficial for Oki, which is kind of that rational self-interest point. So they went to all their current customers and they said, look, we know you're hurting. We want you to keep using the solution. We don't want to lose you. If you don't generate 2 times ROI in a given month, the solution's free. And so until you generate 2 times return on investment, you're not paying us, because we understand times are tough. And, we as an investment partner, we're totally comfortable with that. We just invested, close to $10 million in the business earlier this year. So we have enough cash to weather the storm and get creative. And then for new prospective customers, they said, again, we know you're struggling, but we have such confidence and conviction that when the foot traffic does come back, our solution is going to drive immense value for you. So we're going to offer it to you for free for 3 months. We're going to set it up and implement it for free. And then once the foot traffic starts coming in the door again, you start paying us. And so again, it's this amazing kind of combination of goodwill, not feeling like a vulture on the sales call, but also being in the long-term benefit of the business. And so I thought just a really creative and intelligent idea.
Yep, absolutely.
Yeah, good one. I mean, and we at Opti, our housekeeping software company, did something very similar. So that the company software is specifically focused on housekeeping, dispatch, and maintenance in hotels. Very big and expensive category of hotel operations. So the company did a couple important things. First of all, they started thinking about reopening and came up with a complete reopening white paper, reopening playbook, helping, and to Dave's point, use that as a way to get a bunch of visibility in the industry, sharing this white paper and so forth. And there's been a ton of inbound calls as a result of that. And then the other was to tie fees to occupancy levels. So, companies had this sort of easy way to engage with the software, understand it, onboard the software, be trained on it and so forth, knowing that they would only have to start paying, once they hit certain occupancy levels. Little risky for us because, if we don't hit those levels, but then again, if we don't hit those levels, all is lost anyway. So
yep.
Who gives a shit, right? So in this case, it was, I think it's a really great flexible way of getting in on the category. And I think that the company has done a very, very good job of that.
Yep, absolutely. Dave, do you guys have any commentary on kind of interesting pivots you've seen? Dave, Juan, you obviously mentioned what Toast did with their launch. Anything else that's notable in your portfolio?
Yeah, I would just say, just as a broad point, I think Matt and Chris referred to this. The headwind is obviously GMV is down a lot. The real positive here, and not to be too Pollyannish, is customers are screaming out for products. They need help, and so being human about it, having empathy and listening actually creates massive opportunity because this is a massive trial phase, right? That Satya Nadella said there's 2 years of adoption in 2 months, and it's or actually I can't exactly recall the exact anecdote, but or the exact quote, but like this is a massive trial phase.
Yeah.
And so if you can put products in front of customers that show ROI, this is actually huge opportunities for the folks on this call.
Yeah, and Dave, if I could just chime in for a second, Jordan, I'll be brief. I think it's a really good point, and I think it's easy for us, the four of us up here as investors, to sit up in our ivory tower and preach the merits of implementing software and evaluating new technology, when the reality might be different on the front lines, and you're a hotelier and you're really hurting. But I think there is a lot of merit, and we're seeing it across our portfolio with regards to folks having a propensity to try and evaluate new solutions, because they know in this new normal, there's just going to be such a kind of an inherent emphasis and reinforced emphasis on efficiency and automation, which is obviously enabled by technology. And so, again, that fundamental premise and theory, I think we all kind of palpably were thinking about, and it's good to see it actually happening on the front lines.
Yeah, absolutely.
And sort of just following on, I think that the trends coming out of this will be, in addition to companies adopting software in order to run their businesses more, efficiently, there also, I think, is an acceleration of automation generally, right? What we started to see with the accommodation space, and Sonder is a great example of this, is that there is a very large slice of the traveling cohort that is fine with a fully automated hospitality experience where they actually never see anybody. Now, that's antithetical to those of us who've grown up in the hospitality business. But the idea of automation within hospitality is super interesting, because in the end of the day, you have to remember hospitality is a real estate business, full stop. Yep. And then it's just got this service layer that lives on top of it that creates an experience for people, so they'll spend money to rent a pillow for a night, right? The entire way that the industry has been designed over the last 100 years has never really been changed. And it's been very heavy on labor. And over time, specifically in the last several years, labor costs have been rising faster than RevPAR. It's untenable. Yep. And so we're now seeing, I think, a real shift towards automation. And we're investors. I failed to mention Lifehouse. Lifehouse Hotels was a really interesting management company focused on small hotels, specifically below 200 rooms, totally automated tech stack, really, really interesting company, pulls out basically all of the back office labor is pulled out. A bunch of the supervisory labor is pulled out. So they come into these hotels with their management approach, and they're able to almost double NOI just off of their existing model, all things being considered, all things staying equal.
Yeah.
And so that's really interesting. So if the traveler, and then you add to that trend the fact that everybody's freaking out about touching anything, right? And so we're in this new touch-free environment, which is sort of setting up hotel experiences to be even more automated. I think that the opportunity for those of us in the business to rethink the way hotels are actually run is very, very interesting. And I think that opportunity is going to continue for a while.
Yeah.
So Jordan, I find this really interesting. In the last 3 years, I've given a keynote. There was one at High Tech that I gave to 800 people that is, will tech take your job? And the whole theme was every 55 years, the world changes in technology to a point where it's unrecognizable. And so I said that by 2024, we're going to have one of these events that will shake the world. Lots of jobs will be lost, and lots of jobs will be lost forever.
Yeah.
And new jobs will be created. The problem is that the colleges aren't training the people. So there have to be new ways of training them as well. And then along came COVID. And so, 4 years ahead of time, it was hard to predict in the first place. Now it's easy to predict.
Yeah.
And all of these things are coming true. And it's true in the hotel industry more than anything else, except maybe the restaurant industry.
Yeah.
The service component can't exist at the level that it was before with a number of people that were required to do whatever had to be done.
Yeah.
And so that's going to create some real entrepreneurs making some real choices.
Yeah, absolutely. And Dave, you bring up an interesting point about kind of looking at previous market cycles to inform where we are today. I think one of the things that's been really hard for a lot of tech companies in the space and hotels too is this kind of feels different. It feels like there's not a ton we can glean from from 9/11. There's not a ton we can glean from 2008, 2009. There's certainly things we can do with our balance sheets to kind of fortify them. But it really feels like this time is different. And I think a lot of people are confused. So I'm wondering, like, when you guys look at this market and you're talking to a lot of your, esteemed LPs and your funds who are seeing all different types of businesses, in what ways do you think this crisis is similar? And what ways do you think it's different? And kind of like, how are you guys advising your portfolio companies on how to kind of deal with that uncertainty?
That's a massive question. That one's there's a lot of meat to chew on there. I think that this is incredibly different, right? That there's a way that, unlike systemic shocks, this one feels like it is going to have a long tail. And I think that the supply side of the travel industry is going to struggle to get back to 2019 levels for maybe 4 years or more. That's a really good thing for tech companies, right? Because I don't think you can be a hotel operator in 2024 and not have a sophisticated tech stack at play. You cannot afford to operate off of a clipboard anymore, to run a housekeeping department without software, to have 8 people sitting at the front desk waiting for one guest to arrive and greet them like it's a bank teller. None of that, I think, is going to remain. And I think we could see the hospitality industry taking, a page from the airline industry and figuring out how to create ancillary fees off of some of the services we've taken for granted forever. So, we've got an opportunity to help write the new narrative of what travel is, because I do think that this is going to be long and painful and slow. People are afraid. There are going to be rules and restrictions. I mean, we're sitting here talking on a day when it is possible that the EU will ban us from traveling there. What? Right? I mean, that's astonishing. Yeah. So, what kind of an effect will that have long term? So it's going to be very interesting.
Yeah, Chris, just to add on to that point, it's a really interesting one. I had a conversation with an executive at a kind of a luxury brand, multi-hundred property brand in the Nordics recently, hotelier, and he noted, we've cut 40 or 50% of our staff since everything happened. And, when things come back and occupancy rates and kind of travel starts again, we're not going to be ramping that 50% back up. This is actually our new normal. This is the lean team that we're going to be operating under. And so by virtue of that, he said we need technology. We need to be more open to partnerships versus building everything in-house. And by virtue of that, solutions that can easily integrate and solutions that can drive that automation and efficiency that you're noting that replaces that human labor component. Just really interesting, right? Because you think with this just massive kind of dramatic and acute fall off in jobs and demand, you think, it's going to kind of creep back up, but I'm not sure it really will, right? It's going to be replaced by different things.
Yeah, and in 2019, one of the greatest blockers to tech adoption in the hospitality industry were the unions. I mean, the unions were specifically trying to negotiate into their contracts a no-go on software, which is, I find just almost, shocking. Well, how are the unions going to use their muscle now to prevent software from being adopted, to insist on rehiring people when occupancy levels are at, 44% or whatever they may be? So it'd be the whole dynamics of the power struggle within, at least in the branded space, within hospitality, could be very interesting over the next year as well.
That's interesting, because the unions blocked, or at least they were angry about and pushed back on panic buttons. They didn't want somebody to be Big Brother to know where the maids were exactly. It's just one of the many things that the unions did that didn't seem logical at the time.
Yeah.
So I remember I deal with the earliest stage of the four of us, and we are looking at this point for bargains, because if we wait another 3 months, when people start to run out of money or new entrepreneurs find they can't find money, that's when we make our most. And this has happened in 2000, it happened in 2007, and I need another 3 months for this to happen. But at any rate, we'll be looking for AI, robotics, and probably data analytics to replace people. And that's just like I mentioned when I said, will tech take your job? There are a lot of people who are in, say, computer management today that really are doing simple jobs that can be done by managed processes. And I'm looking forward to having some of these companies come forward in the next 3 months to a year that will answer a lot of these problems with automation.
Yep, absolutely. Dave, Juan, anything you want to add on this, on cycles and kind of how this looks a little different to you than before, or how it might look similar?
Yeah, maybe just maybe a couple things. 100% on digitization. We're seeing that across not only in hospitality, across all S&B merchant classes, and the adoption from the start. I would say that it's similar to 09 in some ways, where there's a fear of flying, and that at some point in time people will fly again, and they will realize that potentially this is safe, and it's hard to predict. I think in 09 it was a Thanksgiving period where people had to go home and visit their parents, and they realized, hey, this isn't as scary as it once was. I think the main difference here as it relates to air, which is the feeder for all this stuff, post the flight, is the capacity utilization, right? There's some health guidelines as to how full a plane can be, and I just don't understand the economics unless the price point goes up significantly. So I would agree with everything that was said in terms of this could take a while to unravel. Fortunately, hotels aren't solely dependent on air travel.
Yeah, absolutely. And there's actually a great question from Marvin at Room Price Genie on this. So he was asking, I'll just give you the example of what happened to us at Hotel Tech Report. I like to joke that this is my first crisis as a real person. So in 2009, I was in undergrad. And so my head was in the clouds. I had no clue what was going on. Like, I would hear about it from my parents, but I went to Williams College. It's a little bubble in Massachusetts, and called it the purple bubble, but really clueless. So like, this is my first time going through something like this, and it's arguably much worse than the last few that we've dealt with in recent years. And so my initial reaction was put on my capitalist hat. We have to like pivot and do something like crazy and different, whether it's like, virtual demo days, or create a new kind of like LinkedIn for hospitality workers that we could pivot to. We had all these crazy ideas. And ultimately what we came back to was like, we're kind of overcorrecting here and trying to do too much. And we reeled it back in, and we looked at what our business was. our business is connecting technology suppliers and buyers. And so we came back to this idea that we just need to keep getting better and doing what we do really well. And there's not necessarily a huge pivot. If we make that really efficient, we could add even more value than we would have added before. And now technology, like you guys have all alluded to, it's a need to have, not a nice to have in many of these categories that are non-PMS, RMS kind of core categories. It's stuff that hotels need to have. So the question that Marvin has is like, no names need to be mentioned, but did you guys see portfolio companies or other kind of like, interesting cases of companies that overcorrected for this and tried to do too much and it was really like they were onto the right thing? Or do you guys have any interesting stories there?
Hey, Jordan, maybe as just a general statement, I would say that pattern recognition is a super dangerous thing, right? Like many of the analysts, I've been through 3Vs, and I think the positive part of pattern recognition, which is recognize the threat and play defense, I think that was very positive. Again, super proud of what SiteMinder did and what Toast did. I think I've been quite surprised in terms of where we're seeing demand and what's transpired. And so I think we've been, as a firm, TCV has been very focused on really understanding core data from practitioners and from the specific merchants. Yep. And we've been quite surprised with where there's demand, how quickly it's returned in certain segments, how challenged it's been in other segments. And so pattern recognition, I think, is useful, but it needs to be applied the right way. So I have seen some cases where people fall back on their sort of playbook from 2009 or 2001, and it hasn't been appropriate.
And I've got an example that has nothing to do with early stage, but think about Marriott. Marriott made this gigantic acquisition, decided to change its technology. That's one of the things that I was involved in only because I had supplied some of this. Yep. And then along came COVID. And so the entire plan for Marriott, one of the largest corporations, well, maybe aside from Accor, the largest corporation in our industry, yep, had to change in a moment. And did. So you got to give Arnie Sorensen a real pat on the back for what he did. But at any point, a lot of the biggest corporations got caught in this too.
Yep, absolutely.
Yeah, Jordan, it's a really interesting question from Marvin, I believe his name was. The way we've thought about it is you need cash. So cash sufficiency is paramount. You need enough cash to weather the storm. And it's uncertain how long and how pernicious the storm is going to be. But on the flip side, you don't want to do things that jeopardize the long-term health of the business, that totally quell product innovation and furthering product development. You obviously need to be having sales conversations in general. So our companies did a lot of really interesting things to get creative as to how to preserve cash and still push those other elements forward. Like, this is a great time to work on product, for example. Some of our sales teams, for example, decided to, or were kind of worked with the management teams to take some form of commission and compensation in equity versus cash. So we would have more cash runway. Thought that was a creative idea. And so just a lot of kind of interesting things that I think you can do that enable you to preserve yourself as a business, make sure you have enough assets to, come out in real kind of fighting form once the storm clouds clear. But also, again, don't jeopardize the business and be too penny wise and pound foolish, if you will.
Yep.
Even the startups did that.
Absolutely. And so we have another interesting one from the audience, from Klaus Kohlmeier at Ideas. So before we all hopped on, I gave you guys my rant about how I was too much of a wuss to invest in Twilio right when it came down, as I was hearing all my messaging clients say that they had to still pay their minimum. Are there any companies that you kind of wish you had invested in pre-COVID that you think are at a real strategic advantage?
Sonder, Chris.
Dave Burkus.
But I can't make that wish.
Yeah.
Okay, well, we can skip this one as well.
Too early to tell.
Yeah, absolutely.
Too early to tell.
It could be, because it takes a lot of cash.
Yep, absolutely. So we're at 45 minutes. We had a bunch of awesome questions come from listeners before the show. So I'm going to kind of pop into some of these. The first one comes from Tim Sullivan, who's the CEO at Sendine. He's asking if your portfolio companies, I think this is super important, are your portfolio companies running scenario analysis for a resurgence in COVID. That's something that we talk about a lot ourselves, and we all discussed before we went live here, is how are you advising them on how to think about that outcome and how to prepare for it? Matt?
I'm happy to kick off, Jordan. Great question, Tim, and obviously, know Sendime really well, just a great potential partner of a lot of the companies that we work with. It's a really good question. I think, our job as investors, the way I see it, is to do a couple things. One is just transparent collaboration, thought partnership, and then really importantly, kind of relaying the benefit of the experience that we have. We have a unique vantage point and perspective, having had the opportunity to work with, in some cases, dozens or, 20 plus companies. And most times, at least for the entrepreneurs that we back, this is the first time they've done this and first time they've scaled a company to this stage. And so I reference all of that because when things like this happen, I think it's really important to lean on your investment partners to just really do some really intense scenario modeling. I can't tell you how many different types of scenarios that we've been modeling for our businesses, but it's everything from, we're getting no revenue and no cash in the door for 24 months to, normal course business rebounds in the fall. And so, and everything in between. And I think just being really kind of agile in how you forecast and really agile in how you react to what's actually happening and coming down the pike, I think is really important.
Yep.
Yeah, I would just add on that a couple things. One is we tend to do two forecasts, a base or closest to the pin. What do we think as best we can, and we roll that out fairly frequently, and then a downside case for managing cash. But I think the second thing, Matt sort of alludes to really rely on your investment partner because they have a lot of experience with the forecasting and the modeling and pattern recognition. I think the other aspect is that the more collaboration is, the more trust. These are really uncertain times, and you want to be really aligned as a board so that you can react if it turns out worse than you expect, or probably just as importantly, or maybe more importantly, if things start trending better, you as a board can be nimble to lean forward sooner than others. And so there's a human element to engaging with your investment team and making this a collaborative effort.
Yep.
Dave, that's a really good point. Just to add one thing to that, it's a great point. Much like I talked about how some of our companies are not being rigid, but rather being very flexible with, payment terms and expectations with customers and partners. Same with us. It would be silly for us as investors to have, the exact same base case set of assumptions that we went into this year with for our companies, because it's not necessarily sensible nor, pragmatic and reasonable to hold them to the same kind of standard that we all kind of thought was going to happen this year. And so I think flexibility, David, you referenced transparency, just collaboration. Those are just such core virtues of how we operate in all times, but really pronounced now.
Yep. And Dave Burkus, I'd love to ask, because, we're a startup. We're not true SaaS. We do have a SaaS element to our business, but we have lumpy revenue. We don't have enough data to make any statistically significant forecast for our business. So we just plan for the worst. I'm curious, how do you advise your portfolio companies who are really early stage of how to plan for this when they basically are flying in the dark?
There are several ways. If we assume right now that we're on the boards, and all of us are on the boards of some of these companies, there are three kinds of questions that we ask that help them in their planning process. Or if they've given us at a board meeting the idea of how they're going to handle this whole thing,
yep,
you've got to ask three types of questions. And we've got to learn as board members how to do just that. The first are obvious, the fiduciary questions. Is this legal? Is it feasible? Is it affordable? Is it sustainable? That could take a whole board meeting. But then you have to ask strategic questions. What's the competitive landscape? What's your PR impact? Does the idea move us toward our goals? Is it too little value for too much money? And that happens in the startup world a lot.
Yeah.
And then finally, one that we really haven't done quite enough of as a group. And it's the generative types of questions. Ask why, what if, alternatives. Is this idea on mission? And if you can do that, whether it's on a one-on-one because you happen to be the lead director or a coach, or whether or not it is because you're on a board and you're trying to direct the board towards strategy and not tactics, and not listen to the usual report that takes up 90% of the board meeting, then there is the model that makes it work for any kind of company, but particularly right now during these times.
Absolutely. And then the next question is actually like from your guys' seat. So we're talking about how startups can plan for this. How are you guys planning for this in terms of like, how are you thinking about deploying capital right now? Having those conversations that realistically, if you were investing in Hotel Tech Report 6 months ago, we would have commanded a very different valuation than we would command today. And I think it's the same across the board. So how are you guys in deploying capital now is the first question, since I like to ask you 10 at a time. And then how are you thinking, how are you really communicating and helping those entrepreneurs understand that their business isn't what it was 6 months ago, and being sensitive in doing so, and also kind of just like persuading them that this is just the reality?
It's another massive question. Yeah, I mean, look, I think that what people have to understand about valuation is that, you know, when we underwrite investments, we use a number of variables to make estimates and guesses about the future. And one of the most important variables that we have to grapple with is time, right? The variable of time, because that is fundamental to how we underwrite the economics, at least for us in our particular sleeve, how we underwrite our investments. And that variable is absolutely unknown at the moment in many ways. It's very disrupted. And so that has to be taken into account in valuation. So this sudden drop in valuation is not a result of us just being a bunch of vultures trying to just, take advantage of entrepreneurs and stick it to them. It's the fact that we are now living in an unknown time, and we have a fiduciary responsibility to be responsible, to deploy our capital effectively for our investors. We also all have investors. And so, I think that's something that's super important for people to take into account. The other thing that we're very mindful of is that, you'd rather not be having to raise money in the next 6 to 9 months. So I think any investment we would be engaging in now, we would be looking for 24 months of runway. Yeah. We can always accelerate that if things are going well, but this is not a time to be betting on the up round Series B in mid 2021. Yep,
absolutely.
Too uncertain.
Yeah, and that actually kind of dovetails nicely into this one. So the reality is that you don't want to raise during this time. I definitely don't want to raise during this time. But for the companies that have to right now, what are the things that they could be doing to kind of make their assets as de-risked as possible for you guys? I mean, Dave, Juan, you talked a lot about kind of boosting the GMV. Matt, I know that some of your portfolio companies have been picking up a lot of share with trials, so trying to show that they're increasing adoption at a rapid clip. What are some of the ways that founders can be kind of putting themselves in the best position possible, assuming that they, that runway may have been just a shitty timing and they've got 3 months left and they need to go for it?
Jordan, I'd maybe make a couple suggestions to these entrepreneurs. I think there's a whole bunch of different ways, and you've listed some of them, and some of the panelists have referred to some of them in terms of increasing validation, whether it's trials or GMV and so on and so forth. I think it's really important to seek out the right set of investors when you try and go raise money. These are people that know you, that know your business, that this isn't sort of a first date. That'd be a sort of first obvious point. And the second is people who've had a long-standing commitment, like my fellow panelists, to the sector, because you just need to get people in this mindset of, hey, the world is pretty challenged right now, but there is a future state. People will travel again, and in that future state, this business will be incredibly valuable. We look at a lot of companies this way. We're underwriting to 2021 and 2022 type of revenues to set valuation versus 2020, because obviously 2020 is an odd year. And if people have conviction, then you can get them there. There may be a higher discount rate, I think, as was mentioned, but people are bullish on this category. People, consumers will travel again. Consumers are traveling now. So there is money.
Yeah, Dave, it's a really good point. I mean, that's one of the beauties of being a private market investor in a private company. is you don't report quarterly earnings, and so you have the benefit and asset of time to figure things out. Now, on the flip side, and I think Chris, you really kind of rightfully mentioned this. As investors, we're measured by how many times over do you return the capital you invest, and over what time period do you return that investment, because that time value based calculation is kind of the proxy for if one of our investors were to invest in the stock market versus PeakSpan, TCV, Thayer, or Mayfair. And so that element has to be factored in for sure. But as a long-term prospective partner and a long-term operator, you do have the benefit of not needing to again report earnings. You can make decisions that are more medium and long-term that really validate and solidify your position and thesis in the market.
Yeah, and I think for the startup entrepreneurs in the audience, I think this is a good example of why of the value that institutional capital can bring, because when you're starting a company, there are many ways to finance it, right? Venture capital is by no means the only way, but we are in the business of building companies, and so venture capital firms tend to hold reserves after they make initial investments, and so ideally you get through this storm by getting some sort of bridge support from your inside investors, your existing investors. And certainly that's what we've been doing with our portfolio, where if you raise money from just friends and family, or more informal sources, even strategic or corporate sources, they're not necessarily on that same sheet of music. And when you find yourself in a point like now, and your inside investors won't support you, and you have to go outside, the impact is going to be severe. So it's just as for everybody who's evaluating, do I go the path of Dave, Chris, Matt, Dave, IPO, or whatever it is. Yeah. That's one of the reasons why you would want to work with institutional investors. There are reasons why you wouldn't. We're not very good at helping you build lifestyle businesses.
Matt, we've talked about that a bit. and
sure.
Dave Gerkes, anything that you think, you talked a lot about, wanting to see, because you don't have the historical numbers, because it's hard to forecast, it's these new concepts, what you want to see is these entrepreneurs being nimble and really adapting to this and showing that they're able to kind of step up in crisis. Or is there anything else that some of these seed stage companies can be doing to make you feel more comfortable about investing in them now? With the caveat being that you're waiting 3 months.
With that caveat now, because we're at the earliest stage. Yeah. But if you think about how to evaluate a company that has no revenue, has a plan that's on a PowerPoint, and that's about it. It's all about the jockey, not the horse. We've heard this too often right now. Yeah. But it really is about whether that person is flexible and coachable. Yeah. And so I ask more questions about the person than I do about the plan. And if we get by that, then asking questions about the plan are the important second thing. And I developed a technique of valuing pre-revenue companies that's been used by a lot of pre-revenue companies over the years. And that's the second thing that I do, is go through their valuation based upon this method that kind of leads them to the same conclusion I have. Yeah. So we are at stage.
Where can they access that method? I know that you have perkonomics.com. Where's the best place they can access that and kind of study up on it to help them think about valuing their businesses today?
If you Google the Gerkes method, you'll find something like 200,000 references to it. It's been used over 1 million times in the last 22 years. So that's not hard to find.
Absolutely. Awesome. Well, you guys, we now have significantly more people watching than when we started, which is a good thing after an hour fireside chat. I want to be respectful of your guys' time. I know you probably have 17 board meetings later today, so just wanted to end on a more macro question from our audience. So Monica wants to know whether you think, and this will be particularly relevant later stage, but also for you, Dave, is like, do you guys see, we saw this wave of consolidation with the TravelClicks and, TravelClick getting bought, but Amadeus in the 90s. There's, Sabre buying Nexus, specifically within the hotel tech space. I think there's reason to believe why this might decelerate consolidation, because to some extent, big is a liability, because if nobody has revenue, the higher your costs are, the worse off you kind of are. So there's this like, we hear from a lot of our clients, we're small, we don't have a lot of expenses, so we're in actually a pretty good spot from a burn rate perspective, but we have a lot of runway. So that's the argument of why consolidation might take longer now. The other argument is, 3 months from now, you see all these companies needing capital infusions or some sort of M&A event, and that might accelerate consolidation. Where do you guys sit on that? Do you think that consolidation will be accelerated or decelerated as a result of this crisis?
That's interesting. I think that I do agree that consolidation will slow in the near term, specifically consolidation driven by strategics acquiring other companies.
Yep.
I do think that there's right now there's a lot of roll-up interest in the marketplace. So mid-market, private equity guys putting together funds to try to roll up in a variety of categories. So it'd be interesting to see if they execute that. But at the same time, I think that the birth rate of startups is going to increase dramatically. So do we consider that a consolidated industry if we've got these sort of strange roll-up attempts happening, some of them not so strange, some of them pretty cool,
Yep.
A slowdown in corporate M&A, but then this acceleration of new ideas. I think it's going to be a dynamic landscape.
The other element of consolidation that I would reference is not necessarily even talking about M&A, but just an openness to partner with best of breed vendors. I think we're going to see that proliferate more and more. You think about the large hospitality brands that historically have been somewhat closed. They've tried to build things in-house and they have massive teams to do that. And I think you're going to see an increased openness by virtue of leaner teams and needing to use technology to automate processes and not wanting to leverage massive upfront costs to get that technology. I think you're going to see folks integrating, systems more and more, partnering with best of breed vendors that have kind of API centricity and connectivity at their core. I think we'll see that a lot more. So that's a form of consolidation that I would say I certainly expect.
Absolutely. And Dave Wan, you obviously are sitting at the kind of that pre-IPO or that big event phase. Where do you see this market going?
Yeah, I think certainly consolidation will accelerate over, call it a 3 to 5 year period. I think unfortunately a lot of companies may go away just given the sales economics have never been great in this space, and unless you can sell a strong enough offering to get the deal points and the price points to support your go-to-market, it's tough. And so there's a natural consolidation that might happen in terms of cross-selling and sharing sales costs. I think as you think about it as a potential buyer in this space, that the key risk obviously is all the product debt that you incur if you end up buying a bunch of companies, smashing them together, and spend all your time integrating rather than innovating. So I think it will happen. I think it's unclear whether some of the growth leaders will be the biggest buyers, but I think there'll certainly be a lot of consolidation.
Yep, absolutely. That was a huge reason why we started Hotel Tech Report. We pivoted. Quick side story. We pivoted from a hotel software company, and it was so brutal selling door to door. The sales economics didn't work. Our marketing message wasn't connecting, and we took a step back and to Dave Burkus's point, asked why. Like, why are we doing this? Is this the best way? And we saw this opportunity to. Instead of trying to beat our heads against the wall with one software company, can we make it more efficient for all of the software companies to deploy in this space beyond, the direct sales, hand-to-hand combat, conferences that are super expensive? Can we do it like other software industries like MailChimp and Dropbox and a lot of your portfolio companies, Dave Wan, are doing? And they're just really lightweight, frictionless SaaS. The buyers are educated. They could try them. They could stop using them. And that's really the future we want to see. So we're hoping that we outpace some of that consolidation. And then Dave Burkus, to that point, I know that you've been involved with some transactions with Constellation, who's obviously the 1,000-pound gorilla in the vertical market software space and a different type of consolidation. How are you seeing this market since you've obviously been really involved there?
Well, what I just got from the other Dave is exactly right. If you name the companies that have consolidated, say, the property management companies,
yep,
which were prevalent in the 80s, there were 160 of those in the 80s. There was no way they could compete. Today, there are probably 12, and I can name the 4 that rolled up almost all the others. So you can look at Agilysys and Infor and Oracle, and let's name a few more.
Yep.
Jonas, and it's to a point now where, as you just heard from Chris, it's going to happen. It's going to continue to happen. And that was the PMS side. You're going to have people operating now, integrating a lot of the SaaS companies because they have a higher value. And it's going to be a great time after we get through this initial shock with people acquiring companies that are now cheap.
Absolutely. Awesome. Well, guys, I know you all have board meetings to run off to. Really appreciate you making the time. I know this is like crazy for you guys because what all of us are dealing with on our side, you're dealing with 20, 30 of those and answering to LPs. So we really appreciate it. I think to our audience of tech entrepreneurs and managers, like, I think this is like pretty clear that not all dollars are created equal. And the best thing you could do, we've talked about a lot of advice and strategies. The best thing you can do is have really good people backing you that understand your market and that can really be there and roll up their sleeves and get in the trenches. And so give all these guys a call. They're some of the best venture investors in this space and have seen it all before. So, it's all about bringing this community together and making sure that hospitality comes out of this stronger than ever. And I think as an industry, as an entire space, we're going to. So let's all do it together. And gentlemen, thanks so much for making the time.
Thanks so much.
Thank you.
Awesome.
All right.
Bye, guys.
Bye.